Good morning, everyone. Thank you for joining us on this lovely Thursday in June. We are so excited to have you for our June FOMC meeting recap. As a quick reminder, all attendees are muted and video shut off. However, we would love for you to engage with our presenter by using the chat feature at the bottom of your screen. You can find that chat feature by clicking those three dots on the bottom of your screen if you're on a mobile device, or selecting chat if you are joining from a computer. Those graphics there should help you locate that. Before we begin, I'd like to introduce our economist on the call today, David Widmar. He is the co-founder and managing partner of Agriculture Economic. David is always kind enough to glean information from the meeting yesterday, interpret that data for us, and then share his perspective of what yesterday's findings will mean for the overall economy and at the farm gate. As a reminder, this webinar is intended for informational purposes only and is not public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. With that, thank you all for joining us. This event will be recorded and distributed following the webinar. David, thanks for being here this morning. We're happy to have you, and I'll pass it over to you if you're ready.
Thank you, Claire. And as Claire said, thank you all for joining us today. I know your time and your attention is your most valuable resource, and I appreciate you carving out time to either watch it live with us or watching the recap. I think this is a really important topic. We've seen interest rates coming back into the conversation, a little bit of a back and forth between the White House and the Federal Reserve about what's the appropriate rate for interest rates. And so we'll see how this plays out over the next several months. But we want to just step back today and recap what do we learn from the Fed's FOMC meeting, and specifically with this June report. They came out with that summary of economic projections, which is a great way to sort of understand where the Fed is coming at when they're making their projections. I don't think it's necessarily a great forecast of the future, but it's a great way to understand, sort of looking at the notes, looking at the thoughts, or considering the thoughts that the folks who are going to be making the decisions around interest rates, where are they today? So we set a baseline of expectations, and so we get to see that baseline of expectations, and then we can course adjust our own expectations based on how the economy unfolds over the next few months. So we're going to dive into that, and I'm going to share here at the end some implications for the farm level interest rates that you all are thinking about and facing. So here is the first table that gets highlighted and talked a lot about. I'm going to walk through this. I want to make a quick point here. This is the median, and as a reminder, median is slightly different than average. We simply line up all of the participants' expectations, and the median is the middle observation. That's going to be important to keep in mind as we work through this. But I want to set that up here. And so I'm going to walk through sort of their baseline expectations and summarize those for us. The first line here shows those expectations as of the June report. And so you can see for real or inflation adjusted GDP, they came in at 1.4% for the 2025 year. And that's a revision from 1.7% back in March. So they're expecting a slower economy. I think this is partially watching consumer behavior. It's also thinking about the impacts or the potential impacts of these tariffs as they continue to work their way through the economy. As we move to 2026, they're similarly expecting a little bit of a slowdown in 2026. But as you see, maybe back out to 2027 and into the proverbial long run, that 1.8% is sort of that top end expectation. So 1.4% isn't a terrible number. Again, it's adjusted for inflation. So this is economic growth above inflation throughout the economy. So the economy is growing 1.4% on top of inflation throughout the economy. So that's positive growth, but it is a little bit of a slowdown from where we were just a couple months ago, and it is not at that longer run sort of target that they have for where the economy could and maybe hopefully will be performing at. Shifting gears, going to unemployment rates. I'm going to talk a little bit more about unemployment rates. A little bit of a spoiler here. I think this might be the Fed's best measure and handle for what's going on in the economy. over the next several months. And we'll talk about why. So I want to highlight this a little bit. They actually think unemployment rates for the economy are going to tick slightly higher, up to 4.5% in 2025, 4.5% in 2026. Again, these are both above sort of that long run expectation, which they benchmarked to 4.2%. March here we had a lower expectation for unemployment in March. So a little bit of a revision higher. Than where we were a little bit ago. I think 5% is sort of a rule of thumb. If we see unemployment rates starting to get close or creep above that 5%, I think that's whenever the warning lights on the dash are going to start lighting up, thinking about, hey, we need to be concerned about the economy, and the Fed's other mandate here, full employment, will start to be a little more front and center. Thinking about inflation, I think this is going to maybe be the Fed's least helpful measure over the next 6 to 8 months. This is the PCE measure of inflation. This is the Fed's preferred measure of inflation. Of course, CPI is the one that we hear a lot about, but PCE is a slightly different way of measuring that. But they were thinking 2.7% PCE inflation for 2025. That crept higher to 3% here in March. Again, 2% is that long run expectation. 2% is the Fed's goal. Why I think 2% inflation is going to be the hardest measure is because we talked about back in March is this idea of the impacts or the effects that tariffs have on inflation. There's short-term in nature, so there's a one-time step higher in the inflation rate, and there's this pass-through. So a 10% tariff on everything in the economy that we bring in, what is that pass-through rate? That's really hard to calculate. It's really hard to project, and it's a one-time situation. So I think this is why the Fed can't really fly by this PCE inflation measure or the CPI inflation measure also as we move through 2025. They're going to have to rely on other gauges, other measures. I think that's why the unemployment rate is going to be their best measure. Unemployment rate's pretty timely as well. So that unemployment rate's going to have, there's a monthly survey around that data, so they're going to have a timely measure of what's going on in the economy there with that data set. Let's get down to the part where we were all here for. The big picture here is that for 2025, they didn't change the median expectation. There's a big asterisk there. Median expectation did not change. It's still pointing to this potential for 2 cuts or 50 basis points worth of cuts to the Fed fund rates here in 2025. So my summary, slower economic growth, slightly higher unemployment, slightly higher inflation, and interest rates unchanged. This isn't a terrible outlook for the economy, but it is a less optimistic outlook maybe than where we were back in March. I do think one of the differences here is that we have maybe a little better handle. There's a little less uncertainty in the markets today than there were back in March. I think the Fed feels a little more confident about those projections that they're putting out there today than maybe where they were just a few months ago. So a little less optimism, but a lot more uncertainty as to how things are moving along. Here's the dot plot. In the dot plot specifically, it's sharing the each participant's expectation for the Fed funds rates over time. So we have 2025, 26, 27, and as we mentioned before, the long run. I talked about no change in the median, which is that middle of the line forecast. But let's look at the range of expectations. 7 participants thought that maybe there'd be no rate cut here in 2025. 2 participants thought there'd be 2 cuts, and then the biggest group, 8 participants thought there'd be those 2 cuts, and then there were 3 participants who think there'll be 4 cuts here in 3 cuts. 2 thought there would be 3 cuts here in 2025. So there's a bit of a spread here within those expectations. Those expectations are considerably narrower than what we've seen and maybe a year ago at this time. But I'm gonna zoom in here on this in the next point here. But I want to shift gears and talk about 26 and 27. As you look down the road, you can see there's a pretty wide range of expectations for where interest rates are going to be a year or 2 from now. You see that there's about 150 to 175 basis points of expectations. That's a pretty big range for something that's 12 to 18 months away. So the point here I want to make is that median gets reported a lot, it gets highlighted a lot, but there's a range of expectations, and that range gets pretty wide as we move out to 26, 27, and even that longer run. Take a look at that longer run. There's a few participants who think we're down here at 2.5%, the median's at 3%, and there's a few that get all the way up to 3.75%. So there's a lot of uncertainty as we move farther down the road. Specifically to 2025, again, the median didn't change, but the distribution changed a little bit. And I want to highlight this just a little bit. And the point here I want you to take away from this is that the future is uncertain, and conclusions like 3.9% unchanged from um, 3 months ago kind of misses a lot of the nuance and the details. And I don't, why I want to set this up is I don't want you to be surprised if we don't get those 2 rate cuts. I don't want the conclusion to be, oh, the Fed said 2 rate cuts, so we're going to get 2 rate cuts. No, there's a lot of uncertainty around that. And specifically, the blue bars show the June projections, and that dotted line show where the projections were back in March. So think about that dot plot. I'm taking that dot plot for 2025, and I'm showing it slightly differently, but I'm also able to include March projections. So what you see here is that 3 additional FOMC participants move their expectation to that no change category. 2 people who thought there would be 1 rate cut moved out. 1 person who thought there was going to be 2 rate cuts back in March moved out, and then we're unchanged over here. So my point here is the median tells us 3.9% 2 rate cuts. But this other way of looking at the data shows us that actually we put a little more weight, a few more votes went into this category of no change. And so I think that's a reflection of some of the inflation concerns, some of the uncertainty around the economy. And the idea here is, yes, the median is unchanged. That's sort of the top line number, but there's a little bit more risk starting to move, I guess, to the no change category. Now, I want to spend a little time on inflation here. As we mentioned earlier, it's going to be a little bit tricky for the Fed to navigate. It's going to take time for those tariffs to work their way through the economy. I think there's still some uncertainty as to where those tariff levels are going to land out. We sort of announced some tariffs and then we delayed how they were going to get deployed. So it's going to take some time to get work through the economy. So far, there hasn't been any major concerns. This is a year-over-year measure. So there's 2 ways you'll see inflation measured. Year-over-year is the one that we're most common and most familiar with. It's pretty intuitive to think about. Inflation back in April was, I think it was right at 2.1% higher than it was in April 2024. This other measure over here is month over month. So if we're going to see a lot of concern with respect to tariffs and tariffs causing inflation to the economy, we're going to see the PCE index on a month over month basis move up pretty quickly. We talked about back in March how I thought that there was a little bit of warming up in the inflation. The problem with this month over month measure is that, a 0.4% month over month change isn't very intuitive. I think one of the things to keep in mind is when we start seeing levels kind of at this 0.3, 0.4% level, that's getting a little hot compared to the annualized rate. So we saw a warm up in the last half of 2024. And then in February and March, this thing dropped off really, really sharply. That's sort of when these tariff conversations started. And so it's going to take some time, but if we're going to see inflation kick up, the Fed thinks we're going to approach this 3% for an average. So we're hanging out, in the low 2s. If they think 2025 is going to average 3%, they're anticipating inflation in the fall to start to creep up on a year-over-year basis somewhere in this territory. I think also if we're going to see this metric probably late summer start to creep higher. This is a good indicator for if we see inflation ramping up. It's not a good indicator to tell us how persistent that inflation will be or how sustained that inflation will be. I think the Fed's going to be really slow to move interest rates based on this inflation data alone because the tariff effects are going to be short-lived, short-term, kind of a one-time type hit. As I mentioned earlier, I think the Fed's best indicator, if we want to think about are things dramatically changing in the economy from the Fed's baseline projections that they released this week, I think it's the unemployment rate. We don't have a huge concern showing in the unemployment rate. In fact, unemployment rates are among the lowest levels that we've seen throughout most of our careers. Again, I think if we start to see this drift up to 5%, the Fed's going to start plotting a different course than where we are today. I think the inflation is going to be noisy for the next 6 to 12 months. I think it's going to be a little more insightful to watch this unemployment measure. It's a monthly measure. And so if we see this starting to move closer to 5% or closer to 4%, I think the Fed's going to be able to use this as a little bit of their guiding indicator, their main indicator they're watching on their dashboard. So let's shift gears here a little bit and think about, we talked about the Fed and the Fed's activity, but how do we bring this back to the farm? And I want to step back and talk about a little bit about how we got to where we are today. On the top left here, what you see on this screen is the Fed funds rate going all the way back to 1990. And the point that I want to make highlight here is we spent some time right above 5% as a Fed funds rate. We've dropped it around 100 basis points. But look at where 500 basis points were relative to history. We're at some of the highest levels here that we've seen going back since the early 1990s. So, for example, we spent some time in the mid 90s between 5 and 6%. We got slightly above 6% in the early 2000s, and then we were above 5% here. So, if you think about this, we have been higher than 5% over the last 30 years, but we haven't gotten much higher than 5 and 6% here in the Fed funds rates. Let's look at the Kansas City Federal Reserve reported. This comes out of this is across all farms in the Midwest. It's the average interest rate that farms face for a fixed interest rate on real estate. And as you can see here, we got up to 8% was the value here that we saw for farm level real estate interest rates. And as you can see, we spent quite a bit of time in the 90s and early 2000s at levels higher than 8%. We were at 9 and approaching 10% in a lot of those cases. So kind of a split screen here. The federal funds rate has been at or near its historic highs, and farm interest rates has not quite got to that level. And that's going to be important implication for what we're going to talk about for where we are today and what's going to happen, I think, in the next coming several months. So let's look about the rate hikes that we saw really since 22 to 23. The Fed funds rates increased by almost 530 basis points. The 10-year Treasury, so let me back up here. This is a 527 basis point increase. We saw the 10-year Treasuries increase about 380 basis points, and farm real estate rates went up by 350 basis points. So while the increase in interest rates wasn't fun to watch, especially as we were looking at our borrowing costs, the reality is that we didn't get all of that Fed funds hike priced into our farm interest rates. In fact, this is probably the case throughout the entire economy, is that interest rates are slow to work their way through the economy. And so while we saw a big increase at the shortest term interest rates, that Fed funds rates, these longer term notes just didn't get priced into that. Some of this is because it takes time to work through. And some of this is the broader debt market was anticipating maybe these rates were going to be a bit short term. And so they didn't have to price in, or they didn't feel the need to price in all 530 basis points. So I think that's a bit of a good news story. We kind of overlooked that when interest rates were going up, is that it wasn't a one-to-one move in the farm interest rates or in the other interest rates in the economy like we saw in the Fed funds rates. Now, what we've seen since the decrease, thinking about the last maybe year or so, the Fed funds rates have came off about 100 basis points. Similar story here. Now it's just working in reverse. This is the unfun side of the reverse. We've only seen about 55 basis points of movement in these farm real estate loans. And so the takeaway here is I think we were sort of slow and stubborn to see farm interest rates go higher. And I think we'll also see them to be slow and stubborn to work their way lower as well. Thinking about this kind of this disconnect between the Fed funds rates and the farm level interest rates, we put together this index to help us think about what's the magnitude. So this is a pricey index, and the idea here is if we looked at all of the kind of Fed funds rates and we said what's the historic what's the historic relationship between the Fed funds rates and all the other spreads there between the 1-year and the 10-year treasuries. Where are we today in observed farm loan costs, and where are we today where we would forecast it to be? One of the takeaways here is that we would expect farm interest rates. So let me flip this around for you. Farm interest rates today that you see are about 75 basis points less than what we would anticipate given where the Fed funds rates are and where the broader debt markets are. Now, this has changed quite a bit in the last few months. We were at about 150 basis points of discount, I think, in those farm interest rates. We have seen other times when these farm interest rates are really pricey. One of the ways that this happens is the uh, yield curve. And when the yield curve is inverted, this drove a lot of this pricey index to be low, is because farm level interest rates weren't as pricey as we thought they would be given where the Fed funds rates. And we've seen periods in history where these interest rates that the farms face are considerably higher than where we think they'd be given the Fed situation. So the takeaway here I want you to think about is that we have a situation where farm loans are running at a little cheaper level than what we would think given where Fed funds are and historically. So looking ahead, based on a lot of comments we get from readers and viewers, and I think even a few viewers on today's call, they said, well, what's going to be some of the farm level implications? And so we put together some data and some tools to think about where have historic interest rates been and what can we think about for projecting maybe interest rates moving forward. And we have a sort of a middle of the road projection, but also a range of potential projections. And what's driving this is that FOMC expectation for that target rate at the end of the year. So one of the things here that I want to point out is that that chart that I showed earlier was telling you that, okay, rates that we observe are cheaper than what the model would think it should be given where the Fed funds is. So even with the Fed expecting 2 more rate cuts in 2025, our takeaway here is that it's going to be slow and stubborn to work its way into farm level interest rates. We've already seen sort of a 100 basis point cut in the Fed, 50 of it working its way to the farm level interest rates. I think that's going to be a similar approach as we move forward. We might see these farm interest rates move lower, but it's not going to be a one-to-one basis. And I think the other thing here to keep in mind is that that Fed funds rate coming down gives us sort of a starting point of about an 8% real estate loan for farm interest rates. And so there's a wide range of observations. I don't want to discount that, but the idea here is that we're going to have to see two things happen. The Fed lower interest rates, but also we anticipate that pricing index is going to work its way closer to the long run average. It never spends a lot of time at that average, but it's going to start to move closer to that average. If you want to get a really good feel for what's driving that pricey index, keep an eye on those 10-year treasuries versus the 1-year treasuries. Those yield curves are a really big kind of rule of thumb to help us understand what's going on with those models. So again, my takeaway here is even with the Fed anticipating 2 rate cuts here, potentially left in 2025, I don't think there's a strong signal that we're going to see significantly lower farm interest rates. That's been the case when rates were going down over the last year. I think that's probably going to be the case as we move through the next several months. We could see farm interest rates come down, but it's not going to be a huge change. We're not going to I don't think we're going to outpace the Fed funds rate changes, and I think we're going to be lagged to that, and we'll still have to keep our eye on these yield curves and where those spreads are and how those spreads stack up to historic expectations. So we just got through the July, we had the June meeting, we have a July meeting. September, they have their updated expectations. There's an October meeting, and then there's a December meeting. So you think about when are they going to make these rate cuts? They have 4 meetings left. So we'll see how that happens. They can, of course, do 2 cuts at one time. I want to also remind everyone Jay Powell's term ends at in May 2026. He technically can stay on the Board of Governors through 2028, but we're going to be moving into this. Who will be the next Fed chair? It could be Jay Powell, but I'm not sure that that's signaling. Even though Trump appointed him 8 years ago to his first term, I'm not sure. We'll see how that happens. So there's going to be a Fed watch on who's in or who's out as the chair. So again, to wrap it up, something I've been reminding you at various points is remember, I think the Fed's has been slow to act, but very deliberate. So if we see the Fed start to move interest rates lower, I think they're going to probably move in a deliberate way. So if they're going to move once, they're probably going to move once when they're confident they can actually move twice. Slow but deliberate. The Fed's job is getting harder, in my opinion. I think they're going to move unemployment to the top of their watch list, and I think that inflation is going to move to the back burner. They can't really put a whole lot of faith in that inflation numbers, given how there's sort of inflation through the broad economy. There's this level, and then there's a tariff effect. And so that tariff effect is short term. And so it's going to be hard for them to understand what inflation is actually doing in the core economy. That's not simply that one time inflation effect. Again, my other conclusion here is I think farm level interest rates are going to be stubborn to move lower if the Fed continues with that path of adjusting lower twice here in 2025. So that's all the prepared comments I have. I look forward to all the questions. You can also, I know they're sending those through the chat Q&A here, and Claire's going to jump on here and help me with that. But you can also reach out and email me with any questions that might come up as you reflect on today's conversation. So Claire?
Thanks, David. One that came through, and just quick mention at the end there about how we could potentially see a change in the chair of that committee. How could a potential change in that person impact the decisions of the committee moving forward?
That's a great question. There's um, a long history of how the Fed goes about making those decisions. I think one approach is the um, chair of the Fed could come in and say, I think we should do uh, X, and then everyone votes thumbs up or thumbs down, either yay or nay. Or the other approach is sort of they meet and they coalesce around kind of a bit of a consensus, and then they vote for that. I think Jay Powell is a little bit more of the consensus builder, so he's hearing what everyone else is saying and then working in that direction. I do think that if we saw a movement to more of the here's what the Fed chair says, and the Fed chair is, moving for this is kind of more what we might see in the House or the Senate, right? Somebody puts together a bill and they're whipping votes up. And so if you see more of this, here's what I think we should do, and I want to figure out a way to get enough votes to get this passed. I think that there's a fear that we might move to more of that style. I also think that the White House has been very clear in their telegraphing that they would like to see lower interest rates. I think the challenge that the White House would run into is what we talked about for farm level interest rates. I think that if the Fed lowers those rates, that transmission to the rates that we see for a new car or a new house or farmland or an operating line of credit, they're not going to move on a one-to-one basis. So it's going to be hard for the Fed to change our borrowing costs in a meaningful way, I suspect. So I think that's going to be a little bit of a tough spot for the Fed to be in. So I think the last point here to make is that the market likes some level of predictability. So if we see maybe a true outsider, somebody who's not a familiar name within the FOMC committee, that could leave the markets a little uncertain as to where things are going to go. But it's still going to be a vote has to happen. There's still going to be conversations. They're still going to be using the same data. So we'll see how that plays out. But I do think that the White House is positioning itself to install a different chair in a year.
Awesome. Thank you for addressing that. That looks like that is our lone question for the day. You must have covered everything. You did a great job, David. We appreciate you. So again, as he mentioned, if you have further questions, they can reach out to you via email or contact us and we can get in touch with David. Thank you again for joining us and providing that recap. Thank you all for joining the webinar to learn from David this morning, and we will see you again next time.
Thank you.